Welcome everyone to episode 49 of Stock Talk with Josh and
Nico Kritikos.
Nico. How you doing?
I'm doing good.
I know it's just kind of weird. We usually don't do it in Zoom. We actually do it in the
Yeah.
studio, but I kind of like so sometimes people I don't want to like be close to Nico for some reason. Kind of got like a bad
What?
odor or something like that. Like on the Diary of a Wimpy Kid, like the cheese touch. He
Yeah.
kind of has that
Yeah.
sometimes.
Oh, thank you.
Yeah, but today, Nico, we actually have a guest on this show, and her name is Jessica Inskip. So everyone around the world who's listening, give a round of applause to Jessica.
Oh, thank you so much.
So Jessica, how you doing today?
I'm doing good. Busy day as always, but happy to be here.
Good. So before we actually get started, we want know a little bit more background information about you. So I did see you are like on MSNBC.
Not MS, but CNBC
CNBC.
and Fox Business. Yep,
Oh,
and TV
okay.
Network and a couple others.
Okay, and what got you started with doing things with those companies?
Yeah, it's honestly a long story, and you asked a loaded question and you didn't even know it. So,
Take your time. Take your time.
Sure. So I've been in the industry for about 15 years, and I actually used to be behind the scenes. I started at a company in 2009 called Scottrade, which doesn't exist anymore, and I
Hmm.
was an intern there. But I was
Hmm.
actually the first female on the active trader desk at Fidelity
Wow.
Investments.
Hmm.
Climbed my way up in Merrill, where I actually spent most of my career. And my job there was called the Director of Advanced Trading Strategy. So I would take complex products and make sure that they were easy to understand, but I
Hmm.
would also ensure that everything from the front end functions, back end functions, data that you saw, as well as to training that reps received, all were compliance friendly and just a really good client experience from the advanced side. And advanced means technical analysis, margin, options, things like that.
I'm curious, what did you go to school for?
Business and organizational management. So I didn't even want to be in the stock market, Nico. I just kind of happened. I thought I was being clever when I got that internship. It gave me a college credit, and I had a
I see.
scholarship, and I got paid at the same time. So,
I see.
and
That's a
I
good thing right there.
actually, yeah, so that I just ended up really liking it. But long story short, that on the CNBC aspect, I've always had this love for financial education. And if you've seen any of my social media, which is how we've met, I
Mhm.
did give up my financial licenses to
Hmm.
pursue financial education. And a lot of that had to do with the amplification of just it's a trend, financial literacy across social
Yeah.
media. Once COVID happened, and then Robinhood really amplified that with their targeted marketing towards the younger generation, Gen Z and
Yes.
millennials. Um,
And I
so
saw
I
you
gave up my
said
licenses. Yeah.
I saw you said something like there's too many creators out there who aren't really qualified to be giving advice, but they're still creating content based around this stuff. Like
They are.
myself.
And but see, there's nothing
Like
wrong with
myself.
that. But then the problem, yeah, that there's this, I think that's great that people are doing that. But what is it's just so unfortunate that the finance industry is more regulated than healthcare. You can go on TikTok and you can see
Oh.
doctors who are fully licensed, and they're going to talk to you. And I learn a lot from that. I really do enjoy
Mhm.
it. But the problem is you don't have that healthy mix. You only have
Yeah.
one, and that amplifies misinformation. And brokerage firms can't compete. And you're not putting out that type of content, or I wouldn't be here,
Mhm.
where it's watch me turn $500 into $10,000. That's
Yeah.
unrealistic
Right.
and
Right.
baity
Right.
and difficult. Yeah. Uh,
So that means that like with your financial licenses, if you still had those, you're not allowed to be making this type of content, or how does that work?
That's very true. So the way that you get your financial licenses, if you have to have a sponsor, and that sponsor is a brokerage firm. So I no
Hmm.
longer work for a brokerage firm, which means I no longer have a sponsor to hang my licenses. I have a 2-year lapse period before I'd have to retake all those exams again, which I do not want
I
to do.
see. I
But
see.
what happens, it's just old rules. You can look them up. They're FINRA Rule 2220 and 2210 and 33110, I think,
Mhm.
where if it just says that if you post any content online, you're a brokerage firm, you have to monitor what your registered associates post. And if you think
Mhm.
about how many registered associates are across the industry, they just strictly prohibit it because it's costly and timely, takes
Yeah.
Oh
way too
yeah.
much time to review it. So
So
it's
are
just not
those
there.
are those exams you're referring to? Is that like stuff like the Series 65 and the Series 63 and all that stuff? Or are those different?
That's right. Yep.
Okay.
Yeah, and Nico,
Um,
you have experience with that. You remember the last couple jobs, you kind of had like some issues of what you do with the
yes,
podcast, things
right.
like that. Yeah.
And that's why right now I've been taking practice tests for the SIE exam. And then it says after I finish that, then you have to start, then you go into like the Series 65 or Series 7, whatever. So that's what I'm working on right now.
Nice. Yeah, hopefully it'll change. That's what I've been trying to do. I met there was a keynote speaker at one of the conferences I was at that worked really high up in the White House that I brought to this attention. So I'm trying not to name names. So hopefully that invokes some change. Because I do think that if you're a creator, you've built a following, you should be able to get your financial licenses and continue to build that following.
Mhm.
It shouldn't
Yeah.
stop you. That just amplifies the issue.
Yeah, I see what you're saying. All right, Josh, what do you say we get started with our checklist here?
Well, real quick, I do have another question, another personal question for Jessica. There's another
Go for
long-winded
it.
question, so I'm gonna like break this up into two parts. So the first part is, what do you like most about working the stock market and overall your job?
I do love financial literacy. I do. My favorite part right now is I get to work with Jim Cramer, and
Oh yeah, I
I
saw
really
that. I
like
saw
that
that.
guy.
That was
He
cool.
is he's so kind. And
Hmm.
he uses I got on the somehow the universe was kind to me, or that I did put sometimes I have imposter syndrome, that is a thing. I've worked a long time at this, but I'm on the weekly, or excuse me, the monthly rotation for the off the chart segment for Jim. And so he's
I
actually
saw
the
that.
only person that I get emails back and forth from. And he's definitely one person on TV, but he also gave up his financial licenses to
Oh, he
pursue
did?
financial education,
Oh,
which I didn't know. Yeah. And
Oh,
so he really cares about the individual investor. He makes so much money, he doesn't need to do what he's doing right now. And he really cares about investing education. And it just doesn't come
yeah.
across that way, unfortunately.
Yeah, I see. That's
all right.
interesting.
So for my second part now, it's just gonna be like the flip side reverse. What do you don't like? Kind of like, man, I kind of like hate going to work and do like, so something you dislike about your job.
Uh, That's a difficult one. I've spent so long in my career, I've now aligned my career with my values.
Hmm.
So if you asked me that a year and a half ago, I could list you off a ton of things. But right now, I have autonomy and flexibility because I was in a place where I could give up my financial licenses. And I still work with all the brokerage firms right now. I work for this company called Options Play, and I consult with them and still provide their educational data and educational content as well. I suppose the one thing I don't like is sometimes I can do too much because I've accumulated some skills, and even though I like to use the analogy, I'm really good at cleaning. Like I can clean really, really well, but I don't clean houses for a living. And just because you're good at it doesn't mean you should do it because you may not like it. So,
Yeah,
but
right.
things like that, that makes sense.
Right.
Yeah, good. Okay, so I think now we're just about ready to head on to our topics. Now, unfortunately, the first topic, we're gonna be a little nerded out about this. You know how boys like to talk about video games and everything. But Nico,
I mean, I love to play Fortnite, so
there you go, there you
here we
go.
go.
But Nico, we got some news too. We talked about this last week, but 37 countries, including the EU and China, have approved the Microsoft Activision deal.
Yeah.
With one country being the UK is the only one to have veto it. So Nico,
Yeah,
how do you think how do you think this is gonna play out? Is like the UK gonna say, okay, that's fine, just go ahead with it in the next 6 months, or no?
I don't know. I mean, the UK hasn't changed their mind yet, but I did see an interview with the CEO of Microsoft, and I think he was almost hinting at that they were just gonna do business with the other countries in Europe and just kind of ignore the UK. So I mean, I think that's a realistic option right now.
Jessica, how about you?
So even though I play some video games, I don't pay too much attention to it unless for the aspects of the stock market. I just think it's interesting how the UK is so different from the EU, especially after Brexit. And traditionally, the
Oh,
EU
you're right.
would be even stricter than the UK. So I'm
Mhm.
just wondering what type of precedents they're trying to set and how big
Mhm.
of a market Microsoft even has in the UK for it to make a dent in their revenue.
I mean, do you think that it's kind of like Activision is almost too big of because I think they're buying the company for 75 billion. Do you think Activision is just too big of a company and they should stay separate, or I don't know, is it anti-competitive, or how do you look at it?
I mean, that's what the UK is saying.
Mhm.
I don't think they would be too big because there is a lot of still gaming software out there, and they're not going to be the only player in the space. So there's still
Mhm.
competition, but everyone lays out their own rules for a reason.
Yeah. And I think Microsoft was saying that like games like Call of Duty, I think they weren't gonna do it where only Josh, what did we say last time about this? I think we said
Oh, it'd probably be like a new Call of Duty game would probably be licensed to like a different thing like Sony or something like that.
yeah, they weren't gonna limit it to an Xbox only
Yeah.
game. They were still gonna allow Sony and PlayStation to use it.
Yeah, that
So
probably they would probably lose like way too much money if they did that. But
yeah. But okay, we'll see what happens.
yeah, like Jessica was saying, they probably do want to stop like an entire like huge conglomeration from forming. But no, it's a lot of
Mhm.
countries that already accepted it, and but we'll
Because
see what happens.
the same thing just happened with Adobe. Adobe was trying to buy Figma for 20 billion, and I think that deal didn't go through either. Because I think
Yeah, I
those
think that got
companies,
stuff too. Yeah.
I think they're just trying to be more strict with preventing monopolies and stuff. So the first piece of news I saw was that Disney's trying to split ESPN as a separate streaming service. And then I'm just kind of wondering like are these streaming services ever going to get to profitability? Because that seems to be for the last 3 years, all the streaming services, or at least the new streaming services, are kind of having troubles with that. So do you think that, Disney Plus is ever going to become profitable?
It's possible. So if that question was directed at me, I don't think Disney Plus, I would look at Disney overall and where their revenue comes from because they haven't spun off just the streaming piece
Yeah.
whatsoever. But I think Disney's biggest issue is they're required to buy Hulu. So they're going to have a big
Oh.
hit to their
Mhm.
operating expense. That's going to be more of a larger issue. However, Disney still had subscriptions go up year over year. They did do a
Mhm.
small price raise, and that was
Mhm.
fine. But now they've got CEO changes and they have Bob Iger in there, and they didn't do
Yeah.
too well last earnings season. And the previous earnings season, they
Yeah.
really only did well from the promise that Bob gave. And then we
Yeah.
got to earnings and he didn't deliver.
But they
So
but they brought the old CEO back though, right?
yeah, that's Bob.
Oh, that
That's right.
okay, okay. Yeah.
Mhm.
But so when you were saying about Hulu, you don't think that that's going to help them?
Well, it's like if you were to put solar panels on your house. At
Mhm.
first,
It
that's
costs
going
a
to be
bunch
a
of money.
big hit. Yeah,
Yeah.
exactly. And in the long run, absolutely, it should
Yeah.
help out because it should drive. Well, I guess that's a poor analogy because solar panels would drive efficiencies that we know would take down your electric bill.
Yeah.
Whereas Hulu, I suppose they have some good ad tiers.
Yeah.
They have sports, which I'm
Mhm.
not going to be the expert in, but I know
That's
that.
Josh.
But there you go. But Disney had ESPN, and that didn't do too well. So perhaps they're
Yeah.
not going to know how to handle the sports.
Yeah. And I also saw like um some article was talking about how they pretty much reached the maximum price for things that they charge at Disney World and stuff. And they were showing how like, popcorn costs $20 there and all this different stuff. So they kind of maxed out their pricing power at the parks too.
They did raise prices, and that I think we've seen the last of that with the overall inflation picture.
Yeah.
So we'll probably see some of that come down.
Yeah.
Yeah, and another thing too, I think with streaming is like cable now. Like we have to like it feels like for the consumer, we have to decide like which one should we buy or well, which one should we watch? Like should I get Disney Plus? But Disney Plus doesn't have this one show that I like that let's say
Right.
Peacock has. It's kind of like the
Yeah.
consumer gets
Mhm.
kind of split and have to decide which one they want. So I think that's not only just the problem that Disney Plus has, but just everyone in general has. So that's gonna be very interesting to see though.
Yeah. But
Absolutely.
don't you think that Disney owns pretty substantial, brands. They own Pixar, they own different, they own Marvel, stuff like that. Like those are important brands.
I mean, they can own as much, like that's nice to own those things, but still with like TV and like shows and things like that, a lot of time
Yeah.
it goes with like trends.
Yeah.
Like yes, they have a Mickey Mouse. We all know Mickey Mouse is one of the most popular character ever. But
Mhm.
what is the trending thing? Mickey Mouse? It might not be. Like they have the new princess, Mermaid. She's trending
Yeah.
now, but the next 4 months, it might be, I don't know, a new Space Jam movie comes out. So now the attention has switched back onto HBO and Warner. So
Yeah, I see what you're saying. That's
this
a
is
good
like the
point.
only problem right there, I think.
Yeah, that's a good point. All right, the next thing I saw was that so like US inflation looks like it's coming down, but I saw that in Argentina their rates are 97% now because their annual inflation is 109%.
Completely
109%.
different issue. Yeah.
Yeah.
I mean, inflation is a global issue for sure. Not too
Mhm.
much familiar with the Argentina off the top of my head. We can talk domestic all day, but
Yeah.
Let's talk the
it is a
domestic
global
then.
issue.
Yeah.
Sure. What shall we talk about domestically, where the whole picture is?
Yeah,
Yeah.
Or how deep do we want to go?
How
well,
long do you have?
it looks
Say
like
that again?
it looks like the inflation has been kind of like stickier and lasting longer than they said it was going to. I think let's see. Wait, your Josh, is her screen all blurry?
Yeah,
No.
I see it. That should fix it. That
It's
is
not
for
okay.
me.
It was for me. No, I think it's okay now.
Mm.
But yeah, so the inflation, I don't know, it looks like I think it's at 6% or so annually, but I feel I mean that's still high historically.
It is, but it's coming down. So here is how you should look at inflation. And I'm going to pull up the numbers as well. We're looking at for the change to come down. And it's
Mhm.
all various issues that caused inflation. So it's not just one certain thing. So,
Mhm.
which means that those various issues they're going to be resolved at different times. So,
Yeah.
Yeah.
what were those issues? Right. So, think about going all this way. I ask how deep. If you go all the way back to the Great Financial Crisis,
Yeah.
so 2008, housing collapse, interest rates were dropped to zero then. And they
Mhm.
stayed that way for 10 years. And when interest rates are
Oh,
that low, that allows for expanding credit and exceptional growth, which is why
yeah.
we have it kind of paved the way for a technology boom,
That's
which
why we had
is
the bull
right.
market kind of lasted that whole time until 2020, really.
So long. Absolutely. Um, my camera is
Yeah,
extremely blurry.
there
There
you
we
go.
go.
There you
Oh, we're back in focus.
There we go. I don't know what happened. Anyway, so we go back to the Great Financial Crisis. Interest rates were at zero, and if interest rates are at zero, that's how money is just going everywhere. And the definition of inflation is too many dollars chasing too few of goods.
Yeah.
So, and in other words, people like to say that the money printer was on. The Fed just doesn't go print money. There's not a machine where they just hit it on. It's the way that
Mhm.
they buy and sell bonds. Quantitative tightening and easing is the way that money
Mhm.
goes in and out of the system and
Mhm.
through interest rates. So the tools that the Fed uses. So
Mhm.
that was part of the overall inflation picture is really, really low interest rates means that your money you have a lot more of it. I probably will never buy another home for a while because I know I'm not going to get an interest rate that's lower than 3%. And if
Yeah.
I would go buy another house and do 7%, that's not smart on my part. So I'd end up getting a smaller home. What's the point?
Yeah.
So that's what I mean by exceptional growth from the consumer side, and that goes with autos and credit, so on and so forth. Then COVID happened, and
Mhm.
that's where things really shook, and that created this exceptional wealth wealth growth of the consumer because
Mhm.
we weren't doing anything. You were at home, and if you had a job, you were just collecting your paycheck and saving it because there wasn't really much you could do with it. But there
Yeah.
was a bit of a technology boom. And then, of course, there was government stimulus. So then there's more money
Yeah.
into your pocket. So that started growing. So that's one. And then you have the Russia Ukraine war that caused supply chain constraints. COVID also caused supply chain constraints. And then if you
Yeah.
think about pricing power and how items get higher and higher, if we as the consumer will go to the grocery store and pay $17 for that a dozen eggs, they're going to keep them at that
Yeah.
price. No one is going to lower it. So the way that the Fed tackles inflation is by tackling demand. They cannot tackle supply. Oh, and then the other component, going back to inflation issues, the huge labor supply issue. When COVID happened, not a lot of people came back into the workforce. So now, and I don't know if you experienced this, I certainly did, is you and a lot of my friends as well, if you wanted another job or you wanted a raise, the best way to do that is to get an offer from elsewhere. So everyone was just switching jobs. I call it the great reshuffle rather than the great resignation. And that's wage inflation. And then if there is higher operating expenses, companies are going to protect their profit margins. That's going to trickle down to the prices. They'll raise prices, in which case that goes down to the consumer. And if you have a higher paying job and you're willing to pay for those higher prices, then they're going to stay. So it's a lot of issues that have to be resolved.
So that means that the interest rates were zero from 2008 all the way until when they just raised them like 2 years ago.
They weren't at zero exactly. They were relatively close. You can go on the government website and look at the interest rate raises.
Or it was like 0.25 or something like that.
It's really, really low, which is basically zero. 25 bips is nothing.
Especially compared to what we have now.
Yeah.
Exactly.
Now, so my next question would be, do you like when do you think they would drop interest rates? Like, do you think that would happen this year, or what do you think interest rates are going to be in a year from now?
So I think they're definitely going to be dropped next year. The market actually projects it in November of this year, which is interesting, but I think it's a different type of market because there's a lot more retail participation. But you have to think about why they would drop them. Either A, their tools are working out really, really well. So inflation is coming down. They could say that job well done. Or B, something broke. And normally it's B. So so if the market thinks that they're going to cut earlier than they anticipate, that's also something that could be concerning and send the market.
Now, do you see, I always think like it's a better situation to have it where the rates are a little bit higher, like whether it's, 4% or 6% versus 0 to 2%, because it kind of rewards the people who are saving their money, and it because before, when you have like, let's say you have 0 or 1% rates, then when you save your money, you're not earning any interest. So do you like feel like there's do you favor a certain like lower interest rates or higher interest rates?
It's an equilibrium, and it's not necessarily a one or the other. It's more of a balance. So if you have a lower interest rate, I can borrow more. So my funds could do more, but if my funds are idle, then they'll make more. So you see the balance that's there. It's almost exactly the same.
But would you say, like, when, let's say, interest rates are, so you said you can borrow for less, doesn't that kind of lead more so into recessions and stuff? That's how you have the bubble pop like that, right?
It could, and that's why they tackle inflation. That's why things like this happen. Otherwise, we just keep it low forever. What's the point?
Yeah, I see. Okay. Okay.
Well, Nico, you want to go on to the next topic? You know more about this than I do.
Yeah, I saw a bunch of different bunch of like demonstrations. First, the Adobe one came out, and then I think about a week ago, I think the Google one came out, and it's pretty much just their new artificial intelligence software for photo editing. And as far as the new one with Google it looks like it's going to be a pretty big threat to Adobe, because Adobe's was super cool. Like, it's pretty much like automated Photoshop almost. But when you see the new demonstration for Google, I think I sent you the video a couple of days ago, but you can do so many things to make like a picture. Like, you take a picture and you can make it look like it was sunny that day, or you can change the way people are standing and all this stuff. And I feel like it's just going to make it where you can't tell if pictures are real or not anymore, because you're going to be able to change so many things. And it looks super real.
Yeah, like that's very cool for all like the content creators, like photographers, things like that, to try and maximize their talents. But On the other
Mhm.
flip side, it's kind of like that's kind of weird. So you can take a picture of me and say I was somewhere else from where I
Yeah.
was really at. That's kind of weird to
Yeah.
me, though. But
Yeah. Or like they had like a
Amazing.
they had like a picture of a bench with a dog and stuff, and they could like, erase half of the picture and then put in something else into the picture. So it's really weird now what you're going to be able to do.
the year of the AI, it's gonna be kind of cool slash crazy slash neat
Yeah.
to see like AI in the next 5 years of where it's gonna go.
Mm-hmm.
I think it's amazing. It's the Fed's key to success, to be
Mhm.
honest.
Oh, you think
Mhm.
so?
Yeah. So AI is something that what I have been talking about since, I don't know, maybe the past year when this whole inflation picture started, that going back to inflation and what the Fed's trying to do and how AI fits into this overall picture. There was not a lot of people came back to work, right, post COVID,
Mhm.
and there is a labor supply issue. So too many jobs, not enough people.
Yeah.
And if you watch every time Fed Chair Powell speaks, he says labor market imbalance way
Mhm.
too often. He can only tackle demand. He cannot fix supply. So
Yeah.
there's no way that he's going to create more job workers unless there's some type of fiscal policy that opens up immigration or something like that. There's no way
Yeah.
that that's going to happen. But if you think about, okay, if I can't get more people to fill these jobs,
Mhm.
how either A, there's got to be layoffs, which obviously isn't going to happen because there's too many job openings. So they just kind of
Mhm.
stop hiring or go in different areas. A
Mhm.
way that you can bring that down is increased productivity. And what increases
Yeah.
productivity more than artificial
AI.
intelligence?
Mhm.
Exactly.
Yeah,
So
I see what
that
you're saying.
will so you can now, when you look at that's why the JOLTS data and the jobs numbers that come out monthly are more important and more of a market moving event, because not only are you looking for, I mean, the real thing is wage inflation, but focus on the problem, not the solution.
Mhm.
And if you see productivity numbers starting to increase, then that's a good sign of inflation coming down and an early indication.
Yes.
And I believe it's AI that's doing that.
And I think robots contribute to that too, because there's lots of fast food restaurants that are integrating that into the. I think which ones? I think McDonald's did that, and then I
Yeah,
think
they have one
Wendy's
in
is set,
Texas that's like fully all
yeah,
automated or whatever.
and Wendy's is setting up something where the drive-through is going to be fully automated by artificial intelligence, I think. So that'll be interesting when that gets rolled out too.
Oh, and
But
there's
the
another
other
So
thing
much
question,
too.
automation.
yeah,
Mhm.
There's another thing too. At some McDonald's, like it's kind of like it's not fully automated, but when you go to the drive-through, it's like, "Hi, my name is like it's like an AI robot talking to you." That I noticed that too.
Mm.
yeah. But Jessica, the other thing I want to ask you is in regards to AI raising productivity. I read an article where like a whole team or a staff at a Photoshop company, they all got fired because AI pretty much took it over. So where do you think there's still going to be in job opportunities for people to do things after they get fired, or what is that going to look like?
Oh yeah. Because we saw layoffs only within the tech sector. And that did
Mm-hmm.
not filter into the unemployment rate going higher because there are other jobs that are out there. And then if you think about this revolutionary aspect that is artificial intelligence, if you think about any other time that this has happened, at least
Mm-hmm.
within our lifetimes, is Apple or the World Wide Web. And when the World Wide Web came out, those are things that were difficult to evaluate because it was something new and innovative and no one really knew what it was. I
Mm-hmm.
say it's a good analogy because you use the internet no in every single vertical or in every single sector. So whether you're in healthcare or technology or finance, you are
Yeah.
touching the internet. But when it first came out, you didn't, and you
Yeah.
didn't realize that impact. So,
Mm-hmm.
and then it also created new jobs like e-commerce, that
Yeah.
the online advertising and all of these online platforms that we rely on didn't exist before. So we don't even know the jobs that are going to be out there. It'll certainly take jobs and increase productivity, but it's at a time right now where there are more job openings than there are people. So it's
Mm-hmm.
okay.
Yeah.
It's not going to kill
That
the
make-
economy.
Yeah.
And
I see.
you brought up the tech layoffs real quick. I want to actually get your opinion on that. What do you think was a big factor of all the big like tech layoffs that was going on?
Say that question one more time.
What do you think was like one big or like key reason for all the tech jobs, people in tech in general, getting laid off?
Yeah, sure. So if you think about when you rise interest rates, it hits the technology sector first. Because if you're in technology, like like Facebook or Meta, I cannot not call it Facebook.
Yeah, I
Meta.
know, I know.
I know it's hard for me too. It's hard for me too.
So difficult. Uh, Google, all of those within that tech sector. First of all, they overhired during COVID. The only one
Yeah.
that didn't was Apple, which is why they didn't have those mass layoffs. Then, if you rise interest rates, when you are innovating and you are in not necessarily the startup world, but you're creating new products, what do you need to do that? Cash. You need lots and
Yeah.
lots of cash. And then what takes cash away? Really, really high interest rates. So then you can't borrow. So they stop innovating. When you stop innovating, you lay off those sectors that are innovating, or at least that portion of your business. So
Mhm.
Meta just stopped with the metaverse,
Yeah.
something that they've had a huge promise of value, which hasn't come to fruition. But also,
Mhm.
what amplified that is overhiring during COVID and then normalization once things reopened.
Yeah.
So that's
So
why the tech
would
sector falls
you
at first.
say that when interest rates go back down, do you think Meta is gonna return to the metaverse investments and all that stuff and then start rehiring people again?
I don't know if they will. They definitely have this year of efficiency and a very interesting focus that Mr. Zuckerberg is doing at the moment.
Yeah, right.
But I think they're going to focus on operating efficiency, and you can already see they had the worst year last year and absolutely
Yeah.
haven't fully recovered, but have been ripping and rallying since January of this year.
Yeah,
Yeah.
right, right. All right. I'm excited to talk about the next one. The next thing
Oh,
on our
Okay.
list here.
oh, you are?
Yeah, I am because so the IRS, so I've owned Intuit stock for a while now, but I actually sold the majority of it because I got worried. Normally I don't do things like this, but I got worried that this was actually a threat. So the IRS said that they're coming out with a free tax filing software by next year, and it looks like Intuit stock and H&R Block was affected by this. So do you think this is a temporary thing, or is this going to actually be because the majority of Intuit's revenue comes from that sort of business? So do you think it's going to be a big
Mhm.
threat to them, or how is that going to look?
Well, it depends on the value that they add. So the stock market is forward looking. So it
Mm-hmm.
prices in new information as it comes to light and then adjusts accordingly. So
Mm-hmm.
the stock market is by no means a measure of the economy, but if you look at an individual security, that's all stock market is, a bunch of companies,
Mm-hmm.
it's their future promise of value or revenue exposure. So
Mm-hmm.
they just took a huge hit to revenue because that IRS is going to allow you to do their part of their business online, but
Mm-hmm.
it's how are they going to adjust from there? Like Meta knew that the metaverse wasn't coming out to fruition. They adjusted by having layoffs and then focusing on Reels monetization and
Yeah.
other aspects that drove their revenue. So if Intuit and H&R Block have tax consultants that they can add that will help that on your behalf, and they or things like that, I haven't gone into the details, but meaning that's an opportunity for you to readjust from there, because all that
Yeah.
the market really cares about is profit margin. So you have a hit to your revenue, are you going to fix with operating efficiency or increasing your revenue? Preferably you want both, so you have expanding profit margin.
Yeah. Because I mean, if that happens and it is a big hit to their revenue, they would have to do something. They'd have to completely change their business, and get a whole new stream of revenue. I mean, they do own, I think they own at least 5 companies though. So they're pretty diverse revenue wise, but I think TurboTax is the biggest one. So if that went obsolete or something, they'd have to really change the business around.
Yeah, I think whatever's one's like
Yeah.
the fastest and like most efficient will probably be the best and like live the most, like adapt, survive. Most Americans, with tax season, we want our money or have to know we have to pay anything back fast. Like we want to do it online quick. It's not like 20 years ago when we're going to our tax lady to do our taxes anymore. So
Mhm. Okay, for the
So
next topic,
Intuit, they are 30% of their revenue is from the consumer
for like
tax
TurboTax,
services.
and then they
Mhm.
also have QuickBooks, which that's like taxes and accounting for small business.
Right? That's about 20%.
Okay,
So they've and Credit Karma. I did not know that
and
their
Credit
revenue from
Karma and
there.
Yeah, I totally
Mailchimp
forgot
and
about
Mint.
Credit Karma. Yeah.
Yeah. So, but that's how I would look at that though, is who has the biggest revenue exposure to
Mhm,
those consumer tax services. And then that will give
mhm.
you an indication of how they could adjust because I'm sure they have something else. So they may just focus on their small business and self-employed, or maybe they completely get rid of their consumer business. And then that's
Yeah,
how they would adjust from there.
and but that would still lower their valuation though, right? As a company. Yeah,
But it did that already. That's why the market
yeah,
immediately tanks when something happens because it says, "Oh, sorry, your revenue's gone. This
yeah.
is not the value of your company anymore. Your company has lost some value."
And really H&R Block would probably suffer more from that than they're probably less diversified than Intuit.
I don't know. I'm looking at it real time right now. I don't even know
Hmm,
H&R Block symbol. What's H&R's block?
I don't know.
HRB.
That makes sense.
Some of them don't make any sense,
Yeah, some
so
of
I
them don't
never
make sense.
Oh
assume
yeah, I
that.
know. Like this
They
company starts with a
are.
G. Why is it X
Like
UK?
Southwest Airlines is
Oh yeah,
LUV.
but that's
Theirs
part
is
of this
love,
is
that one.
the slogan though, I think, isn't it?
Yeah, it is.
Oh, it
Yes.
is?
Yeah.
Oh.
So H&R Block, they are 60% is assisted. Do it yourself is 9.2%.
Hmm.
That's not too bad.
Okay. Okay, so before we go to the next thing on our list, I want to add something in there. I want to ask you about index funds because
Sure.
I've been reading a book lately that it's called The Little Book of Common Sense Investing by John Bogle, I think the guy who invented the index fund. And it's pretty much just a bunch of evidence on why you should be investing in index funds instead of picking stocks. And I think the statistic is 90% of hedge funds can't beat the S&P. So what's your thoughts on that? And do you think that it's worth it for people for investors to try picking stocks, even if the odds are against them?
I think it is extremely important to be diverse. So normally those books go off of compound interest, and there is which is absolutely the best way to grow your wealth. And
Mhm.
historically, that's really well with index funds. And usually the index fund that you're comparing it to is an S&P 500 fund,
Mhm.
which is extremely diverse, averages 7%.
Mhm.
If that's the book, then that makes sense
Mhm.
because if you look at the S&P 500 over time, it's
Mhm.
not the same 500 stocks.
Yeah.
That things move in and out of that. It is the biggest 500 stocks that
Mhm.
are within that fund. There are other funds and index funds that aren't going to do too well, that are concentrated. And when I say concentrated in a specific sector, internationally,
Mhm.
small cap, large cap, there are so many different. So when you do S&P, you're large cap and mega
Yeah.
cap. So I think that if you want to pick stocks, I think you absolutely can because now you have all the tools and resources available to you. You didn't have that before. If you are the Warren Buffett investor who had the advantage of saving wealth since you were 11 years old, well, if you
Yeah.
wanted to look at how a company was making money, you'd have to go through physical pieces of paper. You're not doing
Yeah.
that now. There's so
Yeah.
much, even the tools that I'm using to look up revenue exposure, those are literally
Mhm.
free to anybody. They're not just because I have access to them. I just know
Yeah.
where they are because I'm in the industry for so long.
Yeah.
So I think that helps and makes a difference. Where it is a loser's game is if you buy terrible securities.
Yeah.
So meaning dabbling in penny stocks or
Mhm.
don't look at analyst ratings or
Mhm.
try to there's risk for a reason. So
Mhm.
if you have developed your wealth and you have part of your wealth within an index fund and you want
Mhm.
to pick stocks too, go
Mhm.
for it. I think
Yeah.
it's absolutely fine.
Now, okay, so you said the S&P is the 500 largest stocks. Is the Nasdaq 100 the top 100 largest stocks, or is it different?
No, NASDAQ 100 is all technology stocks and it includes financial services. So it's
Okay,
really
okay.
technology.
Okay.
And they are
But
the
they-
largest ones. Yes.
But doesn't the Nasdaq have a lot of they have companies like that aren't really tech related, like they have like Walgreens, or they have really conservative companies in there too, right?
Yep, that would be the NASDAQ composite, but the NASDAQ 100 is technology
Oh.
focused.
I see.
Mhm.
Okay.
NASDAQ composite is like you said, compass. I'm not saying that word well.
Yeah.
My southern accent's coming out. It is, I think it's over 3,600 now.
Okay.
Something
And
like
so
that. Mhm.
is that what the QQQ is?
No, the QQQ is the NASDAQ 100.
Oh, that's the top 100. Okay.
Mhm.
Got it. All right, Josh, you ready for the next topic?
Of course, I'm a big fan of Apple. You know, what's not to like about this?
Well, yeah, because I've been seeing a lot of news about how India might be the more one of the biggest emerging markets now, and even more so than China possibly. And one sign of this is that Apple said they're investing, or Apple's largest manufacturing partner, Foxconn, said that they're investing $500 million to build new plants in India. So what do you guys think about India being the new hot market, and how does China compare to that?
Makes sense to me. So supply chain constraints. That's a reason Apple had to raise their prices in a result of those supply chain constraints due to the COVID shutdown, because a lot of the parts for the iPhone were produced in China and they had a difficult time getting access to that. And then in a response to inflation, which is really interesting, the iPhone had a different price depending on what country you were in.
Oh,
They adjusted it.
I didn't know
And
that.
so India is an emerging market, and that's also diversification of operating expenses. So, and Apple has one of the best management, I'd say, that's out there. They try to get to a cash neutral, what's the word there? It's cash neutral offering, and which is so smart and amazing. They're notoriously known for having so much cash, and cash neutral means that they want to have cash equivalent to their debt. So that's what cash
Oh,
neutral
yeah.
means. And so that they have a lot of buybacks and dividends and things like
Yeah.
that. So diversifying, though, where if a supply chain issue constraint were to rise again due to any type of issue with China, it's important to diversify your suppliers.
Yeah,
And
right.
India is absolutely emerging from other aspects as well. But it's a smart move on Apple's part.
Do you think so? They're the largest company. They have the largest market cap, right? I think it's close to 2 trillion or something. Do you think that do you think they're almost too big to continue growing? Like, would you expect the stock market returns to be high for that stock, or do you think they're so big that they can only grow at 2% per year or something?
Oh, they can keep. Apple used to be a $2 stock. They'll
Yeah.
go. They used to be a penny stock, actually.
But
I think their biggest challenge is honestly iPhone sales just next quarter, but they'll overcome that really quickly. That's it, though.
But do you think at this size, do you think they're still capable of growing, 10% plus per year? You do?
I
Okay.
do. They have very good management structure. They did
Okay.
not overhire during COVID.
Mhm.
Which is key. It is I work on the strategy side as well. And if you compare, I work in mainly options, and a lot of brokerage firms assess strategies based on the influx of options trading in 2021. That's a comparative view to what happened with technology. You can never compare strategically your best year as normal.
Yeah, right.
And
Right.
Apple did not do that.
Yeah. Okay.
Yeah, and that's a good thing for
interesting.
new investors too. Like seeing all these other companies such as
True.
Google had these big layoffs, but Apple's still standing strong. That's like a good thing in my eyes.
Absolutely. Good management.
Yeah,
Okay,
but
next up our
real quick, I want to say I can't wait for the new iPhone 15 comes out because I need a new phone. So if anyone in India has like the new iPhone 15, like even ready now, just text me, DM me, and
Why
I'll pay
is
for
the
it.
new iPhone going to be that much different than the last one?
I think it's supposed to be some new stuff in it though.
Like what? Like a
I
better
don't know yet.
camera?
Of course, it's gonna be a better camera, but I do think they said it's gonna be like a bigger jump compared to usual.
Oh,
So I'm
okay.
gonna have to do my
Mhm.
research on it, but I do need a new phone.
Okay, well, next up on our list is Home Depot, another stock I own. And
Wait, I think
right
you said
now,
you hate it. No, I'm sorry.
what?
You hate Best Buy. Sorry about that.
No, I don't hate Best Buy. I just was suggesting that uh they could go out of business because I feel like you might as well go to Amazon to buy the same products. But Home Depot lowered their forecast and they expect sales to go down a couple percent. So I guess that's a sign that the consumer is not spending as much as they were the last couple of years. But as for the next 5 years, investment wise, I think Home Depot would be a good investment. What do you guys think?
Do y'all think? Well, real quick, do y'all think that like the overall home market and like people like not wanting to buy homes affects Home Depot too?
Yeah, of course, yeah,
It does, but are
but
people renovating as well?
Yeah, that
yeah.
too. Yeah. But what was
Mhm.
your question though again, Nico?
My question was, do you think Home Depot would be a good investment for the next 5 years?
Mm, me personally, I like
Mm,
Menards better.
That's not a stock though.
I know, but I don't know. Like I'm very like not say scared, but I'm very worried. Some like putting money to those different like retail stores, like try to
Mhm.
invest in them. So I'm not sure. Probably no, but
Okay.
I don't like their financials.
You don't like
Looking at
it?
those now. No. So I think there is also a housing shortage, so that gives me some type of indication that they should do well because I expect there to be still construction, at least where I am. I am in an area where I just see it all the time and it's not affected and rather resilient.
Yeah.
However, um, it's 18.2 next year's earnings, so that's about with the market has
Wait, they don't
expects to
have. Do they have negative
uh-huh.
equity?
Let me see.
I think I want to say at one point they had negative equity. So I think you're right. I think the balance sheet is not as strong as it should be.
And that's okay if they have negative equity as long as the profit margins are expanding. So
Hmm. I feel like
no,
I noticed. How's the balance sheet?
they've got they've got about 14.9. So if 15% profit margin, that's
Okay.
not bad. And they make most of their revenue off of gardening, which I did not expect to see.
gardening is a big business. Gardening
I
is a
did
big
not
business.
expect to see that. That's all. I can't garden. Their revenue goes up every year, and so does their net
Yeah.
income. I mean, that's not a bad thing.
Yeah, because I feel like the companies that are really big, like the Home Depot, the Verizon, AT&T, a lot of the big corporations, they don't have the greatest financials a lot of times. I feel like they're like, or like the airlines or another industry, it's almost like they can get away with worse financials than smaller companies.
Airlines are a little volatile. They're interesting. It's so difficult to make money, I think, in the airline business. And then you have to
Mhm.
rely on gas too, and they've got labor issues.
Yeah,
Um, it's an interesting one
yeah. Okay,
for sure.
Josh, I think our next topic here is going to be relating to the banking crisis.
Oh yeah, I see.
And
Yeah.
because JP Morgan says they will not rescue another bank,
Womp womp womp.
But Janet Yellen says that there may need to be more acquisitions as she's expecting more banks possibly to go under. So I guess
These
Jessica, what do you think? What do you think? Like how long do you think this crisis will last? And do you look at companies like J.P. Morgan or Bank of America as risky investments at the moment?
There is a playbook for this that the Fed has. So I
Hmm.
think that is important to know.
Hmm.
For example, the bank run that happened with the Silicon Valley Bank collapse and the
Hmm.
regional banks is much quicker than usual because we don't have to stand in line to go get our cash. I can just, do it with my phone.
Hmm.
That was a quicker exodus that was also amplified with social media, which also means that the inverse is also true. the resolution is rather quicker because we have data and you can see it. And there is a data point that we don't have access to that the Fed does. So that's why you look for the Fed balance sheet that comes out monthly, as well as the FOMC minutes, which I think are this week, actually. Yeah, they are Wednesday at 2. FDIC deposits. So what's happening with deposits? We want to find out and understand. And then there are lots of extraordinary measures that they put in to make sure that the banks have access to liquidity, and they'll just start providing easing once more. They already have. There's banks their cash coming on the balance sheets, expanding those balance sheets.
Now, in relating to what we just talked about with interest rates and when the Fed is going to lower interest rates, there's also some pressure coming from the banking crisis for the Fed to lower rates, because that would help that situation. But meanwhile, they need to keep rates higher to fix the inflation issue, right? So they kind of have two different, things coming at them.
Yeah, well, it actually helps. So think about what happens when you raise interest rates. You are making it harder to borrow. So you're tackling the demand from the consumer. Now, if you go on the bank side, the bank is now squeezed for liquidity or doesn't have access. Because what they do is, when you have a deposit into a bank, they leverage it 10 times over. And normally they put those within treasuries, which are supposed to be the safest securities out there, but with an inverted yield curve, if you have to access those, they're going to take it at a loss, which now they have less access to cash, especially if you don't have consistent deposits coming in. So now they're constrained for cash, which means they're not going to lend out more money, which is another way of tackling consumer demand, because that just means stop spending money, people. So what's going to stop people from spending money? If it's higher interest rates, or the bank is like, so sorry, you don't qualify for this loan. So it's actually another form of raising interest rates with what's happening and expected. And this has happened before. So it actually helps, even though it's not a direct reflect on the FOMC rate that they're charging banks, because that's what all it is. When they raise interest rates, it's not directly us, it's the overnight rate for the banks. So now the banks are squeezed for liquidity. Now they are squeezed for more liquidity. So now it just comes to us not having access to cash.
But wouldn't that real quick? But wouldn't that negatively affect the housing market too? Then, like, so someone want to go out there and get a house.
It does, but we also have a housing shortage. So people kind of like they flocked to my area, so into the Florida's, Texas, and other areas where they're just buying cash for a house. There's a huge issue there. But yes, it should, and it hasn't. It has a little bit, it hasn't trickled down to rents, but it stops the demand for mortgages. But now there's this normalization around 6%, and people are okay buying at 6%, so they're still buying houses because it's cheaper than to buy a house in an area like Florida or Texas than New York. So the cost of living is still driving this demand in certain pockets of the country.
But okay, going back to the banks, but wouldn't the banks, if the interest rates were lower, then all the investments they made in those treasuries are going to go up, right? So they're going to have more money, and they're going to be able to get their investment back. So that would help with the liquidity issue, though, right? If the rates went back down.
Yeah, I would create more liquidity. Absolutely would. And more borrowing, and everything would rally if that happened, if it was for the right reason.
Now, I mean, going back to I think the banks made a lot of those investments in 2021, I want to say. And I think the rates were maybe 2% or something like that. It looks like, so they're underwater right now because those rates are at we're at like 5% now. So does that, what were they thinking back? Was that just a bad management decision to be putting all that money into those they're not short-term bonds, they're long-term treasuries, right? So was that just a bad management decision, or what happened there?
I think it was for Silicon Valley Bank, and you think it's again goes to diversity. So it's the diversity of your client base. If you are Silicon Valley Bank was mostly VC funded. So if you were a startup, why are you putting money in the bank? It's not to grow your wealth so you can meet payroll. You're going to get funded by VCs, and then you're going to draw down that bank account. And then all of a sudden, if VC funding stops and you're Silicon Valley Bank, you're not getting any more funding. So when
Right.
people want their money, things like this will happen. You'll have a bank run and then you'll go under,
Yeah.
But
which is
like,
what they did. They did not have a diverse clientele at all.
All right, you want to go to down to the next topic then?
yeah, this one's interesting.
Okay, yeah. So we already talked about Meta slash Facebook, whatever you want to call it, but it's really Meta. But it says Meta's making a microblogging competitor to Twitter. So how are we feeling about that? Do you think this thing will be successful, or what do you think?
I'm gonna say yes. I'm gonna say yes.
So do they have like a name
Do
for
you
it?
use Facebook?
Yeah.
No.
Do you? Okay.
Yeah.
Curious always.
Yeah, we're I'm 23, he's 24. He
Got
definitely
it.
uses Facebook more than me.
I always thought that the younger generation doesn't use Facebook at all. I'm hardly
That-
on there, but
That's what a
Well,
lot of people. That's
He's
what a lot of
weird.
people
No,
say.
no. Nico's weird. He listens to like 70s rock all the time. Like he's completely weird compared to the rest of us. He's completely
Okay,
weird.
that's what people say, but I'm telling you, there's a lot of people my age that use Facebook. There's a lot.
interesting.
But back to the microblog.
That's important to know, though. That's important to know if
Yeah.
the microblogging is going to work, though. That's why I asked that question.
Yeah. And it looks like the microblogging thing is going to be, it says it's going to be more connected to Instagram than it is Facebook. So that's, and
Yeah.
Instagram does have the younger demographics too. So, you know,
Okay.
I don't know what this app's going to look like, but I feel like Meta is, I don't know. I feel like they have a good track record of coming out with stuff and being successful. Besides for the metaverse, they have a good track record of being successful with stuff.
Yeah. I mean, Marcus said it's the year of efficiency, and he's focusing on things to drive revenue. And I was surprised with this last earnings results. I was expecting them to beat earnings purely on operating efficiencies because of all of the layoffs that they've been doing.
Yeah.
But they actually had more revenues, and it was from ads. And seeing the
Oh.
ad space expand when you expect to have this restrictive environment on the consumer is interesting and a very good sign. So we'll see. I think there's some interesting social media wars going on.
Yeah, and I think that Meta is, well, Twitter kind of suffered for a little bit because of Elon Musk. I think a lot of people / companies didn't want to buy ads on that platform just because they don't like Elon Musk. But I think Meta is kind of like the number one go-to company if you're a business who wants to do advertising online. I think Facebook and Instagram are going to be at the top of the list for most businesses because they have the most users. I think they have over 3 billion users across all platforms. So I think Meta is number one.
Yeah, I mean it's been doing well. It's been number one stock this year for sure.
Yeah, but on social media, you should say things go by trends. And the most trendiest thing around here is TikTok. And we actually had big news with TikTok this past week. So it says TikTok is now banned in the state of Montana. How are we feeling about it?
Jessica, you can go first.
I try my best not to get political at all. But I think it's a mistake.
Yeah.
I think so too.
Yeah.
I mean, Josh, you think that that just because it happened in Montana, that's not a good like representation of what's going to happen across the country. But I feel like there's going to be more states. I feel like this opens the door for more states to make a similar decision.
I wish I had data like where's the hottest like content creators or like people that use TikTok the most. It's definitely people with the highest like states with higher population maybe. But I just wish I had like a chart data. But kids are in love with TikTok, and kids are the future. So
yeah, but
maybe we think like maybe you could say like Vine didn't last that long. Vine lasted what, like 4 or 5 years if that?
Yeah.
When it was really hot. And TikTok's been around for what, 3-4 years now?
Yeah, but don't you think that Instagram Reels and YouTube Shorts and stuff and Facebook is it almost transfers over to those platforms. People can watch the same type of videos on those platforms. And most creators are posting the same video on all platforms anyways. So I feel like, I don't know. I feel like if TikTok got banned in the whole country, then people would just watch the same things on Google or Facebook.
Yeah, but I think with the TikTok algorithm, even though it has the issues, the big drama that's going on with the algorithm, it probably is probably the best algorithm from all the social media access. So I think that's still
I
one
agree with
thing.
that.
That's going to be
I
one
love
thing why
TikTok.
people, she loves TikTok. Who doesn't love TikTok?
But see, I don't know if the if what's the word? I don't know if there's like I feel like 2 years ago, I feel like it was much easier to get views than it is today. So I don't know if there's more creators on there or what happened, but I think it got flooded with more creators and it kind of not saturated the market, but I feel like there's more competition now.
I'm sure it's saturated the market. I'm feeling that too. I do think it's a good algorithm though.
Yeah, I think so too. Jessica, when did you start on TikTok?
It was November of last year.
Oh, so not that long. Okay.
Yeah, about like 6-7 months. No,
Yeah,
longer than that. God.
Okay.
Yeah.
It's already June, just about.
And I know. Completely new for me. I mean, because remember, I wasn't allowed to do it. I had to give up my licenses to even post.
So you're right.
Well, at least the content that I'm posting.
So you gave up your licenses like last year?
Yep, February of last year.
I see. Okay. All right. Well, we got a couple more topics to hit here.
Sure.
The next one is the debt ceiling. Consumer debt hit 17 trillion despite mortgage loans declining. What do you guys think's gonna happen?
So, all right. Do you know how many times we've raised the debt ceiling?
20,000 times.
That's a high number. Over 100 times. And I really try not to get political. So I like to keep that a mystery, even though some people might know it's obvious. It doesn't matter what side, right? So one side, they say, spends way too much money. And then the other side takes away the revenue. So they each do the things to the debt ceiling, right? And so we have a very divided government right now, which means nothing happens, which is actually notoriously and normally good for the stock market, oddly enough, when nothing happens fiscally, but not in this point with the debt ceiling. So the only time that we can point back into history where this was relatively close was back in 2011. And when you have this game of chicken or the standoff between each party who aren't agreeing, it took an outside force for them to finally make a decision. And that outside force was a 17% decline in the stock market. So that's the thing that we want to avoid. But I don't think one party wants to be responsible for that. And just like we can take action, they can raise the debt ceiling and then be fine and then have their little fights and figure it out from there. It's just an agreement. It's like if my child was arguing with someone else and I just have to step in and say, hey, we're going to do this for now and then we're going to figure it out in a moment. That's what they need to do.
But if they don't raise the debt ceiling, that means that they're not going to be good for paying back on the bonds? Is that what that means?
Well, they're going to have to choose and they haven't done that before. So it's prioritizing they're going to have to pay the bills. So and that's what this is what drives me insane about the whole thing. When you raise the debt ceiling, you're not saying, oh, you can spend more money, or you're just saying you can spend the money that we've already agreed and authorized. It's not.
I see.
Yeah.
It's not anything more. So what's going to happen is you don't have money to pay your bills, so they're going to choose it. And so what type of bills is that? It's our creditors, mostly China. Or are we going to fund the military? Are we not going to fund some of the healthcare or any government sponsored programs? Are we not going to pay Social Security? That's why if we do not come to an agreement when the debt ceiling is hit, it has a detrimental effect on the economy, because people who rely on Social Security, if they were to cut that off,
Yeah.
that would be terrible.
So okay, so what's the reasoning for not raising the debt ceiling?
They are having this game of chicken. And like I said, it's like toddlers fighting. The
Yeah.
Republicans are saying, Democrats, you need to stop spending money right now. We're not going to agree to a deal unless you agree to X. And then Democrats are saying, well, Republicans, if you don't agree to this part of the IRA bill, then we're not going to do anything. So they're literally just having this tit for tat.
Yeah.
That's it.
I
They're
see.
using it as a
It's kind of
leverage.
it's kind of like a wife versus a husband kind of thing. I don't know. Where are we going to
I
dinner?
suppose.
We're
Which
getting
one's
steak.
the wife and which one's the husband?
We don't know.
I like to say toddlers, but we
That's
would
even
think that.
better.
I mean, my house is a democracy, but maybe some others aren't. And I have a 12-year-old son, so I get it to his arguing, I suppose.
Okay, I think we have what, 2 or 3 more things left. The next one on this list is
Oh, this is a good question too.
This might be a difficult question, but how do you determine a fair PE ratio for a stock? Or let me give a little bit extra to this. So like some companies will typically trade at, let's say a 10 PE, and then some companies like Amazon or something is going to trade at 40 or 50 times earnings on a normal basis over a long period of time. So is there a strong reasoning for that, or can Amazon start trading at 15 times earnings tomorrow?
Sure. So always look at forward year earnings, not current.
Okay.
I think that's a huge difference. You look at overall the market. So all the time you'll hear the market's trading at right now, I think it's 18 times next year's earnings. So that's just saying in comparison to the overall market, this is where we think earnings are. Then you have to layer on, you can do it with sectors. So technology notoriously always had a higher forward year PE ratio because they had higher revenue expectations and higher earnings per share expectations. So it's those three put together. If you see a high PE, then it better be married with or come with higher revenue expectations and higher earnings per share growth. If it doesn't, then it's overvalued. And that's when you layer on more technical analysis and you say, all right, this has been way overbought. I expect this to go down now.
But let's say, okay, so like Amazon, let's say for Amazon, you could have said over, I don't know how, at least the last decade, if not longer, Amazon traded at a high PE ratio. So you could have said 10 years ago, I'm not going to buy Amazon. It doesn't look like a attractive investment because of it's trading at 50 or 60 times earnings, but you would have made a bunch of money if you invested from 10 years ago. So I guess, do you see a way to distinguish, one, like Shopify is another example that traded super high, but Shopify has fell a lot more. But do you see a reason or a way to distinguish, like, is it fairly trading at 50 times earnings? Like, I don't know. It's hard to explain, but what do you think?
I get what you're saying. It's everything around it. If that whole sector trades that high, then that's your benchmark.
Okay.
So it's kind of like it's always an amazing thing when I have a sports analogy. So that's we always get excited because I don't care about sports. Anyways, like if you have a good player on a team, here's my sports analogy. You're gonna compare them all, right? Like the quarterbacks. I'm gonna butcher it, but if you've got a Tom Brady, he might have a higher PE ratio, but you're going to compare him to the other ones. You see what I mean?
Yeah,
but he has a higher promise of value because you know that he does more touchdowns and things like that. Did I do it? Because it's a really big deal if I do a sports analogy.
That makes sense to me.
Yeah.
Right.
But I guess
running joke.
You're still taking a risk though to say, let's say you say Amazon is worth more, they have a more promising future than the peers in that industry. You're still taking an extended risk by paying 50 times forward earnings for a company like that though.
You are, but you're not guessing on it. You have data. You have analyst expectations. there are people who are going to look at Tom Brady and be like, he does X, Y, and Z. We expected this out of him.
Yeah.
Where analysts do the same thing with securities. They say, okay, they do their free cash flow analysis, EBITDA, whatever they do to come up with the analyst expectations, and that's inclusive of revenue expectations and earnings per share expectations. And so
Mm-hmm.
they're going to use that data and tell you if that's higher than normal, then that also justifies a higher than normal PE.
Mm-hmm. Or like, have you heard of Teladoc Health?
Yes. Mm-hmm.
Okay, so that's a stock. I think during the pandemic it was $300 a share at least, something like that. And I think today it's like 25 or something like that. Because back then it was trading at, I want to say 10 times sales, somewhere in that range. Today it's like 1 time sales, if not lower. So, I mean, back then you could have said, oh, it's trading at 10 times sales because they're expected to grow 30% per year. But then that whole story changes. And, now you would be down 80% on your money if you invested at that time. So I guess, is there a way to prevent falling into that trap?
No, that's the risk of the stock market. So you
Hmm.
have to have an investment thesis. You have to understand the entire macro environment. And Teladoc was a great example of how the new normal was not defined yet, but there
Hmm.
was I suppose, bets is the right
Hmm.
word, made on what that new normal would look like. And that
Hmm.
certainly wasn't Teladoc. Where are they at? Yeah, they have negative growth expectations.
Yeah. Hmm.
Mhm. But
Okay.
it's an overall macro picture. That's the way that I look at it. So it's where
Mhm.
is the market going? What's the risks with the current market environment? What are the headwinds and what are the tailwinds? So right now the big issue is the overall inflation picture. When that's
Mhm.
resolved, we're going to see better returns, but uncertainty is volatility. They are one and the same. So what I'm looking for is productivity increases. So AI is a solution to a major macro headwind, which is a labor shortage.
Mhm.
There are a lot of concerns around energy. So alternative energy is something
Mhm.
that you see coming, especially. And then you also look at earnings calls. Like they said the
Mhm.
word reshoring and AI so many times. I don't have
Yeah,
the
every
exact
every
numbers in front
company
of
says
me.
AI. Every company says AI now.
They do. And that's also something, those are bubble factors that you have to watch for. But if you have the larger caps that actually have proven revenue, like Apple, if
Mhm.
they say they're going to do something with AI, I believe them. If this penny stock, I don't. So
Yeah.
that's where there's a difference. So if your overall macro picture, which just means big environment stock market picture, is in
Mhm.
line with a security that you're picking as well,
Mhm.
you just have to do your homework. Just like you were going to go buy a house or rent a house, whatever you're doing when you get your house. If you were going to go to the bank and get a mortgage, they're going to require you, or even when you go rent, they're going to say, can you meet these obligations? Can you
Mhm.
show us that you can meet these obligations? And then you
Mhm.
yourself are going to say, okay, is this temporary for me? Do I want to live here? Maybe I'm getting a duplex and going to have some multiple income streams, or this is temporary until you go elsewhere because you really want to go there. Like that is the same. It's a big decision you're making about your life and your
Mhm.
money, and so is investing. So you just have to do
Mhm.
your homework. That's really it.
Yeah. Okay, what about this situation where I think like McDonald's is an example of a stock where for multiple years it traded at, let's say, 15 times earnings, and now today I think it's like 30 times earnings. So is that to say that this is the new normal? Like, would you feel comfortable investing at this point, or would you say that it's going to revert to the mean and it's more likely to go back down to where it used to trade?
Are you looking at forward year PE or current PE?
I want to say it's trailing PE.
Okay, that I never ever look at. They are 23 times next year's earnings forward
Okay.
year, and 6.5% revenue growth and 9% earnings growth, which is
Hmm.
overvalued. Um,
Hmm.
that's not doing a whole process, but that is definitely overvalued in comparison to the market. But then that's where I
Hmm.
would layer on my overall thesis.
Hmm.
McDonald's is considered very defensive
Yeah.
because if there was a very constrained consumer, that is
Hmm.
a cheaper food alternative. So if you're going to
Yeah.
quit going out to eat, that's something that you may not cut back on your spending.
Yeah.
So
If anything, they'd
if
get
you
more business probably.
I am about to buy
exactly, so
10 McChickens now, just because Jessica said
there
this is overvalued. I'm gonna make sure it's undervalued.
yeah, I mean that, but that's the reason why it looks overvalued is because it's trading higher than it should in comparison to the expectations, and that's because people are still spending because they see it as defensive. Does that
Okay,
make sense?
would you say I know I'm spending a lot of time on the PE ratio, but would you say this is a fair way to look at things? A lot of times I will say I'll look at the last decade of where the stock traded at PE wise, and yes, it is trailing normally. And then I'll say, okay, I'll base it off of that relative to where the PE stood the last 10 years. Would you say that's a fair way to analyze it?
I would say historical average is absolutely fine, but I would do it
Mhm.
by sector. But then I would compare that to the forward year PE because
Okay.
you're trailing PE, you're trailing probably 12 months. That's what has happened, and we
hmm
care about where it's going.
hmm Right. Okay.
There is a FactSet has overall market PE. You can just Google it, FactSet earnings insight or something like that. Free and Refinitiv as well. Those are two
Okay.
good ones.
Okay.
All right, so I guess it's time for the next topic. We already talked about index funds. You still
Sure.
want to bring that
We
up, or you got something else to
no,
add?
we already addressed that.
Okay, 2023 market prediction. So by the time December
Mhm.
31st hits, we're taking a recap of how wonderful the year 2023 was. How do you think the market's going to look?
Ooh, that's always a tough question. Um, I'm feeling 4,600 on the S&P, hmm led by NASDAQ.
Okay.
I
How
love your
about you?
response.
Just, Nico, how about you?
Well, see, the way I've been viewing things is the first I want to say pretty much the month of January, I think my account was up 30% or so. So I feel like January was up 30%, and from February to now, I pretty much have been flat. So I think a lot of those gains for the year were priced in that month of January, and I feel like it's going to be flat for a while, and then 2024, I would expect it to go up more because I'm not expecting to have the market go up 60% this year or something. I think the 30% that it's already up is quite a bit.
I like how you started it off. Like, yeah, who cares about the market? Let's talk about just my stocks. My stocks are
Well,
going.
no, but
So
the
the stock
market
market should be good.
the market's doing so. The market is similar. The market was
Yeah,
close to 25% or something up.
yeah, you're right about that.
Maybe he has all 500 S&P 500 securities in his account.
That is true. No. Oh yeah, for me too. I think it's gonna be just around the same thing too. I like the word flat. I think that's gonna be the name of this episode. Flat. I like that.
Flat,
Flat. Yeah.
sideways
Yeah,
consolidation.
pretty much, yeah.
hmm
Okay, I think Josh, we got one more question on here, and then I kind of want to ask her one or two questions after the episode is over.
Okay, so let's real quick. Stocks? Oh my God. What stocks are you most interested in buying right now? I'm gonna start off
If
first. I'm gonna say,
if she's allowed to discuss that.
oh yeah, if she's
Well, I
allowed
can.
to. Okay. Well, I'm gonna start off with mine. So I'm giving Nico some time to think. Um, I'm gonna look at some like a lot of EV type of companies like
EV.
Honda. Yeah. Like
Okay.
even like car companies in general. Like what's that, 2025? It's gonna be a very interesting year, how the car market's gonna shape up with electrical vehicles and all of that. So I'm looking at Honda because I see some news. Um, what's the news? They having some they're pushing to Europe more by using China built EV. So I'm kind of interested in that as well. But just looking overall the entire car market because I like cars too. So I'm kind of interested in how that's gonna look.
Nice. I don't hate that. I think EVs are good. That's certainly Especially with the Inflation Reduction Act, there's a lot of tax credits on there, incentives.
Exactly. Yeah.
Mhm.
Nico, you got a
Mika?
stock, or
I got quite a list here. Yeah.
how about you just say two of them,
Okay, if I was gonna pick two,
or just do like an industry you're looking at or whatever.
not an industry, I would say Tyson Foods.
I thought you bought that
And-
already.
Yeah, that's what I'm. Yeah, I
Oh,
would say
okay.
like it's at a good price right now to buy. And then I would say 3M.
Okay.
Those would be two good ones, I think.
Defensive. All right. I'm looking at AI because of the productivity increases. Huge opportunity there. Because of AI, cybersecurity, that would be something that will absolutely be amplified.
Mhm.
With you on the EVs, solar, on anything that has to do with reshoring as well. Yeah, and I think anything with activist inclusion is very interesting to me to watch. And TikTok gives you really good insights as well. One of my stock picks off of I said on CNBC was literally off of TikTok because everyone was saying you got to go to Pinterest, you got to go to Pinterest. They did this, and like, wow, consumers are
I
using
love
Pinterest,
Pinterest.
and that
I love Pinterest.
it played out really well because they said, oh, we had more downloads than usual. I'm like, TikTok told me, so saying
That's
that
int-
already happened. But I'm just saying that's a good way to look at things. You can use trends.
Yeah, Pinterest is very good at.
The other one I like right now is Airbnb. I really like Airbnb, but I pretty much have built out my position in that, so I don't think I'm going to add any more. But I think right around $100, I think is a good spot.
All right. So I know you got questions for after the podcast. So let's wrap this up real quick for episode 49 of Stock Talk with Josh and
Jessica.
Jessica, thank you for being the co-host for today's episode. And once again, round of applause. Clap, 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 clap. For joining us.
Thank you for having me. Lots of fun.
All right. Well, people are out. Nico, you got anything else to add?
Nope, that's it.
All right. Bye-bye, everyone. And to greener days ahead.